Hi, everyone. I welcome you all to this webinar session. A very good evening to all of you. To begin with, let me introduce myself today. This is Simran Birgi here with you, conducting this session. I work with FX Primus, holding a rich experience in the industry for more than 8 years now. The idea behind conducting this webinar today is to help my fellow new traders as well as the experienced traders to get some logical and disciplined approach while they're trading in the market. Talking about the content, I would like to brief you what all we're going to cover today, starting from some basic terminologies about the Forex market. I'm going to take you through the trend analysis and the various types of trend that is useful for us while we're trading on the market, knowing which direction to enter. Apart from this, the most important thing is which indicators we're going to use while we're trading and working on the trend analysis. Thereafter, we're gonna take up a small discussion on our trading plan and why is it crucial. So this is, I'm just encompassing what we're gonna talk about today. So taking you about the brief of the market, as we all know, the Forex market is the world's largest financial market, having a volume of more than $3 trillion per day basis. We all need to understand who all are our market participants while we are trading in the market so that we can understand the market, how wide the market is, and what role does each participant take into to manage our risk and know our performance in the market. So talking about our hedge funds and commercial banks, investment banks, and of course our Forex brokers, and not to forget the most important, the investors who are playing a big role in the market. Moving further, I would like to take you through about the different sessions that this market has. So we have, so talking about the market sessions, while we say that this market runs 24 hours a day, throughout the 5 days in a week, we move through different sessions, beginning from Asia session in the morning, moving ahead to the Tokyo session, and thereafter entering the London session, and hence ending our day with the New York session. My friends, before we go ahead, let me just take you through a bit about what kind of risk this market holds while we're going to deep dive into knowing more about this market and understanding how beneficial this can be. So we just need to take you through about this market can be also very risky since it's a marginal trading that we are getting into. So we need to keenly understand what we need to safeguard ourselves while we are trading on the margin products. So coming back to our market sessions, it's important to know different market sessions for us to understand what's going to impact our trades while we're trading on a London session or we're trading in a New York session, because there can be abundant fundamental news is coming over which can impact your trades in respect to which instruments you're trading. Also, not to forget that when we are trading on different sessions, we see a pattern of overlapping sessions while we are trading between Tokyo session and London session, or while we are entering into the New York session. So during this overlapping of the sessions, we can see a lot of choppy movements because we see a crowd of traders who are closing their positions and some of them just opening the new positions. So there is basically no clarity of the trends, but yes, we can get some liquidity there to have the best price for our open trades. So we can definitely make some benefit from our understanding about the different sessions of the market. So I've given you a gist of the different hours of different market sessions for you to know it better. Moving further, I would like to take you through this basic terminology where you know, the new traders often come across these questions like, how do I interpret an equation like Euro USD is 1 point blah blah blah. So when we talk about, let's say Euro USD is 1.17426, so we need to understand that what is the base currency here and what is the quote currency here. So the one on the left of the equation, we call it the base currency, and the one on the right is the USD, which is the quote currency. So when we talk about the base and the quote, we see 1 unit of the base currency is what we are going to get when we give out 1.17426, let's say, of USD to buy 1 euro. Or if we are selling 1 euro, this is what we are going to get by selling 1 euro in the market. So this is a basic understanding that we need to hold when we are trading and we're trying to choose a particular Forex pair to enter the market. So another important term that we come across is bid versus the ask price. So this is basically nothing but what price we need to sell and buy. So when we talk about bid price, it represents the price at which the trader can sell the base currency, as we have discussed what is the base currency. So when we come across the bid price, we know this is the price that we get in the market at the moment. And the ask price is nothing but what price a trader can buy in the market. Often when we trade in the market, we come across a slight difference in the bid and the ask price. This is the price which we call spread. The spread is what the broker actually owns when he's offering a platform to you and getting you the liquidity to trade in the market. So it's a gist of what bid and ask price mean here. Another important term we're going to take you through is the leverage. So since we know that we are working on leverage, depending upon different traders, some might choose to trade on leverage, some might not as well. But as a basic understanding, when we're trading on leverage, we know we are using the margin to trade, which is depending on how much leverage we are getting from the broker. So if we are getting a leverage of, let's say, 1:100, we're going to just invest an equivalent of 1% of the transaction value that we're entering into the market on a particular financial instrument by taking a position of 100 and just paying or using $1 of the margin required to enter a particular market transaction. So this is an understanding of leverage. However, we should not miss understanding here is that the leverage is a double-edged sword, because using leverage can give us an edge over getting higher profits while using a little margin, but at the same time, it can enhance our losses if we are using a high leverage while trading. So I would like to just give you a small example here. How does it make a difference when we use small leverage or little leverage as compared to a higher amount of leverage while trading in a market? So when we talk about trading on, let's say, I've taken an example here of USD JPY, where I've taken up the current market price as 120. So while you are trading on a leverage of 50 times, you see the trading capital of 10,000 leads you to a loss of 4,150 if your price goes against you of 100 pips. So unlikely when you're trading on a leverage of 5 times, your loss would be much lower, almost 10 times lower when you're trading on a lesser leverage. So this is how trading on less leverage can safeguard you from exposing yourself to higher risk. This is why we need to understand that we should only get into high leverage trading if we have enough capital to safeguard ourselves. So this is a basic understanding of leverage, and like I said, leverage is closely interrelated to the margin, which is nothing but dependent upon the how much leverage we use is defining how much margin we need to enter into a trade. So I'm going to take you with a brief example here that margin is how we calculate is depending upon, let's say if we get a leverage of 100, so we just need a margin equivalent to $1 if you're getting off a price of $100 or a market transaction value of $100. So the more the leverage you take from the market or from the broker, the lesser is the margin needed to enter into a particular transaction of a given volume of a financial instrument here. So very often we feel that the margin is actually a cost to the trader, but I would just like to clarify here for my traders that it's not a cost to a trader, it's rather just an amount set aside on your platform, which you can use to float in the market for by entering into a particular position or in a trade. So it should not be confused with a cost. Because like I've mentioned earlier, the cost to a trader is just a spread that the broker is charging to you. So you need not get mixed up with that. All right, so another basic term that we use is the pip. I've mentioned earlier about the number of pips going against you when you're trading on a leverage in the previous slides. So some of you might not be sure about this. So just let me have you through with this. So pip is nothing but a smallest price move, which we count on the 4th decimal place here, as I have highlighted in the image, you can see. So when a price goes, let's say it's 1.1234, it goes to 1.1235, we say the market has moved 1 pip. So this is how we understand what is the pip value here. So it's basically the 4th decimal point. And I mean, some brokers can depict the prices, the market price with 5 decimal points. So you can generalize that as a pipette. So like we see here, it's 1, 2, 3, 4, 5. So any movement in the 5th decimal point would be a 1 pipette movement in the market. These terms are generally useful when you're understanding about how you are risk managing yourself. And this is a brief of how you calculate the pips. So when I said how you risk manage, you have to understand how many pips depict what is the value of 1 pip when you are trading on a particular currency pair or a commodity. So I've given you an example here where the value of 1 pip is multiplied by the contract size, and you have to divide by the current market price to get how much would be an impact in dollar value when the market moves by 1 pip. So here I've taken the example of Euro USD, where I've multiplied the pip by the trade size of 100,000, which is the contract size of 1 standard lot, and the exchange rate was given by 1.13798. So we actually multiply the contract size with the pip and divide it by the market value to give you the worth of each pip. So you can calculate if the market goes against you 100 pips or 50 pips or goes in favor, how much value in dollar or whichever currency you are trading as a base currency on your platform is what you get the value from each pip. Similarly, when we talk about metals, we call the movement in the decimal, which is the 2nd decimal place, as the tick value. And we need to know by this calculation how much worth is 1 tick move in the market by multiplying it again with the contract size. So we know that this is a movement of 0.01, which is 1 tick multiplied by the contract size, gives you the worth of $1. I mean, just to take you through, when I mentioned to you about standard lot size, 1 standard lot size is the actual contract size which 1 volume holds on a platform of any particular instrument. So you can enter in the market with various proportions as per your broker allows you on the platform. It can be a mini lot or a micro lot, and the units can be proportionately calculated as we have mentioned here. So you are now aware of most of the Forex terms, which we have discussed now. These are the basic terms that we use. Just gonna cover a bit about here on the margin calculation. I hope it's not a lot of terminologies coming together, but they all are very primary to your trading when you start trading as a new trader especially. So I'm sure the experienced ones knows about it already, but for our new traders, I just want them to be very, very aware about these terms. So it's going to be helpful to them. When you talk about margin calculation here, so I have discussed in the previous slide that we can find our margin on the basis of leverage as they are correlated. So the formula here gives about how to find a margin, which is you use the trade size and the margin and the market price multiplied together. So we've taken the example where the leverage is given as 50. So the margin comes out to be 0.02 with this leverage. It's just division. So we divide this by the trade size, where we have taken one standard lot here, and the market price given for Euro USD, which we have stated to be 1.072. So our required margin for Euro USD one standard lot would be $2,145.8 US when the leverage is given to be 50 here. So this is how we calculate the margin for FX pairs. Talking about the metals, it's quite similar actually. We just tend to multiply the contract size. The only difference I see here is the contract size. We take the current market price and we take the margin and we multiply them to understand what margin do we need to enter into the market at a particular given point of time with a given leverage. So I hope this example here help us understand very clearly about the correlation between margin and leverage, which is very often a confusing point for a lot of new traders. So I believe we have done justice here in discussing this. So now it's going to be, we're going to talk about more on our candlestick pattern. So to move ahead with candlesticks, I would like first of all you all to know about what is a candlestick. Again, for our new traders, they need to know what does a candle depict, and what do we call, why do we call a particular candle a bearish candle or a bullish candle. So we need to have a quick understanding here to know. So you can see here an image of candle where there is an open on the top on the pink candle and a close in the below. So this candle depicts a bearish candle, why the prices opened at a high and have closed at a lower. So which means the prices has gone down. However, there has been fluctuations during this candle time frame. So the market has moved above the open sometime and has gone below the close as well, which is giving the entire length of the candle. However, we talk about the open and close, which is the main body of the candle. Similarly, for the bullish candle, the candle has opened on a low price and has closed on a higher price, and it has moved high during the course of that candle time period and has gone a little low beyond open. So it's giving the entire movement across the candle, across this bullish candle. Just for your understanding that when you see the charts, there can be a candlestick chart which you come across. So you will see different time frames. So you can see the candlestick pattern on different time frames like minute chart or hourly chart or daily chart or a monthly chart. So on these charts, each candle will be depicting the close, the completion of one candle during the day, let's say for a daily candle, or during an hour for an hourly candle. So each candle is covering for that particular time period as you choose on your platform. So this will give you an understanding about where the markets have moved in terms of the open and close prices. And the candlestick is basically one of our very important technical tools to know the price action in the market. And they are abundant of different types of candlestick patterns that I believe we should be discussing in future for you all to be professional in using candlestick patterns when you're trading on the technicals precisely. So, well, we're going to take that up in future for sure. But for now, for your understanding, I've just taken this in a brief, as this is an important part of your terminologies and understanding while we are trading on the market. So coming down to our primary discussion point today, which is trading with the trend. Yes, it's a very important topic here, because a lot of times we have seen traders getting demotivated and losing the interest in the market because they have been unsuccessful. But let me tell you all that trading against the trend has been a big reason for many traders, unfortunately, that they have been losing or couldn't trade well on the market. So it's been rightly said that trend is your friend unless you know how to use it. So my friends, you all need to understand what is a trend, what types of trends do exist in the market, and what are the different ways or the indicators that you can use to analyze a trend and apply them in your trading strategy. So talking about what is a trend, so just the gist of it, a trend is nothing but an accumulation of the past prices and the current prices, which has been gathered through the economic factors that has happened in the market or has been running in the market. It helps you define the future course of action of prices. So by giving simple patterns to understand where the market is going to move. So understanding those factors sometimes might be difficult, but if we are able to understand where the trend is going, it will be easy for us to understand what direction of market you should be trading on, and thereafter, of course, it's going to be helpful to you to be successful while you're trading. So let me not forget to mention here that if someone is being good at trend analysis and using them to the best of their ability in the right direction, they can be as successful as any other experienced trader in the market. So you should not lose hope with the market and keep trying to learn more about this market, especially when we have got this chance to know more about trend analysis today. So let me just take you through about different trends in the market, different types of trends that exist in the market. So there is a long bullish trend that we call, which is depicted very clearly by the higher high and higher lows in the market on the candlestick pattern. So when I say higher high and higher lows, I would like to give you a brief here about how do we assimilate this. With higher highs, we mean to say that the opening of the new candle is high than the previous opening, the opening of the previous candle, and the close of the new candle is also higher than the close of the previous candle. So I've covered here basically both higher high and higher lows. So if you see, the low point of the candle is also higher than the previous one, and the close is also high. And if it is giving a consecutive pattern like this, at least 2 candlestick patterns completing higher highs and higher lows, it's a good indication of a bullish trend. So we can really understand the concept of a trend to be bullish when we see such pattern in the market. It will help us understand what direction the market is moving. Similarly, when we talk about short or a bearish trend, we witness lower lows and lower highs. So like I've said, earlier, when we see the opening of the new candle is lower than the previous one, and the closing is also lower than the previous one, and as we witness consecutive candles with such pattern, we can understand this trend to be a bearish trend. However, we should not miss out on that the trends can have different strengths, which is also very crucial to understand for a trader, because to understand how you enter in the market specifically, when we say trend is a strong trend or a weak trend, we need to understand what type of trend is the uptrend also. So we should not forget that understanding this can help us know how potential is going to be our position in the market and how much risk we are prone to. So talking about a strong uptrend, we can witness a long string of higher highs and higher lows, which is basically non-retraceable sometimes. So this gives us a very strong uptrend indication. A flaw attached to this kind of trend is, this kind of an uptrend is that it gives hardly any retracement or a pullback for the traders to enter and grab the opportunity of the uptrend in the market. But then at the same time, there are often breakouts when we are trading on different ranges. So we can look for those breakouts to enter into an uptrend, a strong uptrend in the market. By the way, this can be really beneficial, or I could say profitable for us, if we are able to tap on the right entry point here. Then talking about a weak uptrend can be defined, you can say, with the new candles opening above the 50% level, a little more of the previous candle, but it's generally, you can say, the selling pressure is slightly less than the buying pressure when we're talking about a weak uptrend. So you can assimilate by the volume of the buyers and the sellers in the market from this. Also, when we talk about a healthy uptrend, which is one of the categories of an uptrend in the market. So this is the most easy to catch one, I would say, in case of uptrend, where you get enough opportunities of the market retracement, and you can enter at the right price, unless you know how to assimilate those right entry points or the retracement levels, so for which you can use different indicators. We're going to cover a few indicators in the further slides, so it's going to give you a good insight on that. So for now, we have this brief on the type of uptrend. Similarly, you have weak, healthy, and strong downtrend, and you apply same definitions to a bearish trend or a downtrend when it comes to strong, weak, or healthy trend, and you can grab the opportunities on the retracement on the healthy downtrend, unlike on a very strong or a weak trend. Last but not the least, we have a sideways trend, which is more like a congestion or the accumulation of prices. So we also call it often a range-based trading trend because there is no outbreak happening here. So the traders don't really get the right direction of the trend here. But then we can always try to enter if we want to get into an intraday trading. So we can target small prices between the support and the resistance levels. So we can target on a spring and enter the market, or on a pullback towards the next resistance level or the support level. And we can capture the small market moves there if we are sure about the direction of the trend, for sure. Yep, so this is about different types of trend. Now we're going to talk about trend analysis, which is a key here. I have briefly mentioned about what are higher highs and higher lows and how they are useful in ascertaining the type of trend. But they're also very useful to mark an entry or the exit of the trend type. So let's say if you want to understand where is the beginning of an uptrend or where is the trend going to end. So this will give you a good insight about if it is the beginning or it's nearing the end of the trend. We need to very keenly focus on the candlestick patterns here, or in general the chart patterns here, to understand what is the movement in terms of higher highs and higher lows. This is giving you an insight, a very important feature to understand your direction of the trend. While we are trading on the trend, we should not really focus one-sided on the technicals, looking at the charts, because sometimes, we need to also focus, actually all the time, we have to focus on the fundamentals as well. They are like your two eyes, fundamentals and technicals, because when you're trading on any particular instrument, you need to be watchful that if there is any important news coming up or during the trading session or regarding that financial instrument or any geopolitical factor that can have an effect on the prices of the instrument that you are trading on. So you need to keep an eye on both of these while you're using the trends or trying to analyze your trends while working in the market. So fundamental analysis also help you quite a lot in understanding the length and the strength of the trend. So it's equally important, which need not be missed for sure. So I'm going to take you through the technical indicators here, which I believe are very valuable to help the traders in identifying the trend. Apart from the discussion that we have in the previous slide about higher highs and higher lows, some of the indicators that I've covered here are trend line, moving average, stochastic, and Fibonacci. I'm not really taking them in a lot detail, but I'm surely going to cover them to the extent that you should be able to understand that how useful they can be, and maybe a little bit about how you can interpret the trend by using these indicators. So talking about the trend line to begin with, as we all know, that trend line is just connecting different prices in the market, covering the past trends and heading into the future to give you the direction of the trend. So it's very important to understand how to apply the trend line, because if you're able to apply or use this indicator in the correct manner, there is no way you can go wrong in understanding or analyzing the trend. But if you don't apply this correctly, your entire analysis may go for a toss. So it's very crucial to know which indicators and how to use them. So you need to connect the 2 points of the trend line to the pivots of the close prices of the running trend to understand where it is heading to. And just for your understanding, that a trend line can be a very good support and resistance to the movement in the market. So let's say if the market is breaking down the trend line and is holding below, it can depict a very strong indication of a trend reversal. So you can consider this line to be very powerful when you're applying this to your charts. Apart from this, when you understand that it's an upslope trend line, it's a clear indication that it's a buy for the market. While if you see the trend line is in the downward slope direction, for sure it's a sell for the traders. So this is how you can use this indicator to clearly identify the trend by correctly applying it to your charts. So let's focus on the word correctly, because it's very, very important here. Apart from the trend line, I would like to take you through other indicators now, which is moving average. specifically moving average crossovers, which are a very crucial indicator to understand the direction of the trend. Talking about a bit of moving average is actually an average of the previous number of periods of prices that we accumulate to give the next prices or the future prices on the moving average line. So the moving average can be different periods, let's say a 20 period or a 14 period or a 200-day period. So it depends which interval of time are you trading on. Are you trading on a long term or a short term? You can accordingly use different set of moving averages here. So when we talk about moving average, you can see two different categories of moving averages. One which is an exponential moving average, and one that is a simple moving average, which is just averaging out or giving equal weights to, let's say you're using a 20-day period moving average. So it gives an equal weight to all 20-day candles in the past and gives you an average of that in the 21st candle. Whereas when you talk about an exponential moving average, it's trying to give you the most recent momentum in the market by giving more weight to the recent or the few previous candles than the earlier ones, to give you a more sensitive view about the market. So generally traders you would like to use the exponential moving averages so that they get a more accurate average of the market while they're using moving averages. Although we generally use two moving averages to understand the impact of the crossovers. So when we talk about two moving averages, we generally take two different period moving averages, So let's say we take a 9-day moving average or a 30-day moving average, rather both, to understand the crossover concept in helping us analyze that trend. So talking about 9-day and 30-day moving average, when a 9-day moving average, which we say a small period moving average, is trying to cross over the 30-day moving average and go below the 30-day moving average. So we call it a direction for the bearish trend in the market. These are just a couple of the indicators I'm covering here, and we need not rely on just one indicator or one particular move to enter the market and define our trend. So before I finish with the crossover, I would like to bring this up, that we need to always make a combination of different indicators to get the confirmation. So when I'm saying the moment we see a small term moving average crossing below the higher term moving average, we can depict that it's going to be a downward trend or a bearish trend. Yet at the same time, we need to get a confirmation either from our candlestick pattern, seeing if there are any lower lows or lower highs, let's say for the bearish trend, to get a confirmation. And similarly, when we see that our short-term moving average is crossing above the higher or the longer term moving average, we see it's an indication of an upcoming bullish trend. So again, we're gonna get this confirmed by other indicators. This is why we use multiple indicators together. In a gist, so moving average crossovers help us in this way. It's very easy to use. However, we need to be sure which period moving average is suitable for us. Like I said, depending upon what time period you're choosing to be in the market. So you can decide by yourself, and you can find these indicators on the platform along with their properties to choose from. This is how a moving average is going to be helpful to you in identifying the trend. Moving further to stochastics, and also we have RSI as an oscillator, which I've not mentioned here though, but it's just closely, it's more like a stochastic only, whereas there are some features different from stochastic. But talking about stochastic oscillator here is actually giving you more information about the strength of the market or the direction of the market. So it's actually a separate window which has 0 to 100 levels. So it's showing you if the market, it depicts you if the market is above the 80 level and it holds there for long. It shows that the market is quite strong in the uptrend. However, it's an overbought situation, but still the buyers are in strong pressure and the market is still trying to hold there. At the same time, it's also trying to tell you that the market is already overbought, which means that you need not really enter at this price unless you have a confirmation that the trend is still ongoing and it's not getting into any trend reversal pattern, which you can verify from your main chart window by using the other indicators that we have been discussing. So similarly, when it's showing you the price line going below the 20 points in the stochastic, it depicts that the market is oversold, and if it holds there for long, which means that the sellers are in strong pressure, and you need to be watchful if there is any chance of a trend reversal here towards the bullish side. So you need to sometimes wait and watch or analyze using the other indicators. So like I've said, stochastic and RSI, it's relative strength index, which both can be working similarly to help you ascertain the strength of the trend. But we more often use stochastic. That is why I've covered it here, that because stochastic is actually giving you the price line with the close prices, the close of the market prices. So it gives you a more accurate picture or the blueprint of the market, which we say. This is why we call them oscillators. So this is about stochastic. And then talking about Fibonacci. Fibonacci is a very important tool, I should say, to understand the strength or the length of your trend, because it's clearly defining various percentage levels, which also play an important role as support and resistance. So for example, when you draw a Fibonacci on your past trend to understand the current trend, you will see it gives you some ranges with different percentages. Like I've mentioned here, it's 23.6%, 38.2%, 50%, 61.8%, and then 78.6%. So out of these, the 50% level and 38.2% level are the most crucial, and of course the 0 and the 100% levels, which give you an indication if the trend has totally retraced. So Fibonacci is basically you understand the retracement level in the market. Why we apply this to the previous trend is to understand that if the current trend has already retraced back up to the extent of the previous trend. So if you see the market is already reaching on your Fibonacci levels to 100, you can see that it's close to 100% retracement level, and this can basically be going into a reversal pattern here if it doesn't give you a breakout from the 100% level. Similarly, talking about the 0% level, the Fibonacci retracement, if it's touching the 0% level, you can sense or maybe wait for if there's any trend reversal. But then if it breaks out from the 0% level, again, you can expect a trend to continue, but the strength is not yet confirmed. So maybe if you are very keen to enter, then you can look for the next best support or resistance level, looking at your past market prices in the chart, or you can just wait to see if it is retracing back or a new trend is getting set in the market. Fibonacci is very, very crucial. Again, let me say, repeat it again for you, because it's important here. Like I said, for trend line, you need to know how to apply this indicator to make the best use of it. It's actually an amazing tool to use if you know how to apply it on your charts. So I would suggest you need to understand this more deeply to get the best use of it. I'm likely to cover these indicators individually in detailed fashion, but it's going to be in the future webinar session, so we can have more discussion there. So having covered most of our topic about trends and trend analysis, I would like to take you through how important or how crucial is to know our entry and exit points while we are drafting our trading plan. Trading plan is very, very crucial, be it a new trader or an experienced trader, because very often we get stuck in the EFGH mode, which is, being emotional, fearful, hopeful, and greedy while you are trading on the market. So having a trading plan set in place will help keep you away from these emotions and fear, and let you be more logical when you're trading in the market. So talking about entry and exit points, again, there are a lot of tools which can help you understand the right entry and exit in the market, and understanding them is, again, very crucial. So I'll just take you through a gist of it, the steps that you need to take care when you want to find your entry point. As we have discussed already, the trend analysis. So trend analysis is the very first step which you need to follow when you are looking at the entry point in the market, or when you plan to enter in the market. So entry point will be defined by, first, what is the trend in the market, which gives you which direction you're going to enter into the market. Henceforth, you can see the right entry price or exit price. Talking about the entry price here, you can look for the support and the resistance levels. So basically, when entering, you can see what price is more nearest to the support level, the best nearest support to enter if you're looking at a buy side of the market, if the trend is bullish, let's say. So, and you can see the next resistance level to see how much pips or how many ticks you can cover while you are entering into this trade at a particular price in the market. Similarly, like we have discussed about Fibonacci levels and moving average, these can give you the ranges between which you can trade, and you can decide which all levels you want to target depending on how long you want to stay in the market. So when you're deciding on your entry points, you need to be very, very clear about what volume you're going to enter into the market, based upon what kind of margin do you hold in your account, of course. Not moving away from the how much leverage you're using in the market. Okay, so considering these factors, it really helps you to understand what can be the right entry points. Apart from this, there's another important feature that you can use, which is the limit orders. So the limit orders can help you enter into a predefined price below the existing market price when you're at the buy side of the market, or it can also let you enter into the market above the market price when you're on the sell side of the market. So this is an important feature which you can choose while you are going to trade in the market to get your right entry point. Similarly, I would like to cover the exit point here, because both entry and exit are equally important. They are like the balance. So you want to know the exit points here. You can again use some tools like stop loss and take profit levels to make sure that you are pre-planned about your exit. So you would predefine your trade knowing that, okay, I'm going to enter the market here and I'm going to exit at this particular price, targeting these many pips, holding this volume in my account with the current margin status. So you will be able to judge your trade before you enter the trade actually. So it's like firing a bullet from a gun, and you know where it's going to land. Unless you don't have if you don't have a plan, it's like firing a bullet without knowing where it's going to hit. So you'd rather be more planned before entering into a trade by using these indicators. And nonetheless, I would like to cover up a brief on the risk-reward ratio, because when you're entering in the market, maybe you are a short-term trader or you be a long-term trader. It can vary accordingly, but you need to know what risk-reward ratio you are getting into. So generally, we say for the short-term traders, if you're letting yourself in the market for a short time, which is more advisable, because the more the time you're in the market, the more you are exposed to the risk. So you need to have a very limited risk ratio, risk-reward ratio for yourself. Let's say the average, you can say 1:3, which is advisable. But if you are looking at a long-term trading, holding a good margin in your account, you can always target a higher risk-reward ratio for yourself, assimilating all the market noise and the fundamental impacts. But these ratios going to help you, again, predefine your trade and help you be more confident when you're trading in the market. All these factors are a precursor to a successful trading and can let you help manage your trades in a better way. So if you all can contribute to understanding these parameters and applying them to your trading style, it's going to help you all make use of all the information that we have shared here today. So if in case you have any questions for the discussion that we have so far, you can feel free, write me here, and I'll be able to answer you back. If not, I would like to take a leave and thank you all for this session. Have a nice evening. Take care. Bye. Good day.